This is Mortgage Morning, and I'm Andy Baker. Here are the housing and mortgage stories shaping the market today. This is Mortgage Morning for Tuesday, December 30th, 2025. Market signals. Pending home sales jump again. The most concrete housing data to land in the past 24 hours was the National Association of Realtors' pending home sales report for November, which showed a 3.3 increase in contracts signed, the highest reading in almost 3 years and well above what economists had expected. This isn't just a seasonal uptick or statistical noise. It came in stronger than forecasts and followed modest gains in October, suggesting that buyers are increasingly active heading into the new year, even in a still high-rate environment. The geographic breadth of the improvement, with the Northeast, Midwest, South, and West all showing growth, tells you this isn't isolated to one or two markets. For a broker or loan officer, higher signed contract activity means the pipeline, at least at the front end, is more robust than many expected, especially as we move past typical seasonal lows. It's not a boom, but it is a signal that buyers are engaging when they see conditions they can work with. Market signals. Home price appreciation at multi-year lows. Another timely data release came from the government price indexes, showing more than home prices in October increased at the slowest annual rate in over a decade, rising just 1.7% year over year. This marked the smallest increase since March 2012 and points to a continued moderation in price growth even before winter pricing pressure typically shows up. That matters because one of the biggest structural barriers to purchase activity over the past few years has been price acceleration outpacing wage growth. A deceleration this sharp, if it persists in the coming months, could ease affordability pressures, not dramatically but meaningfully, for certain buyer segments. It's a data point that partially aligns with the pending contract strength we just talked about. What we're also watching, Fed liquidity usage surges. While not mortgage-specific data, another market story that crossed the wires today was a notable spike in the use of the Federal Reserve's standing repo facility by banks, with nearly $26 billion borrowed Monday. That level is the third highest on record and reflects typical year-end funding pressures. For housing markets, this is a financial plumbing signal. Heavy use of liquidity facilities doesn't mean distress, but it does reflect how banks are positioning for quarter's end and managing balance sheets needs in a tight rate and capital environment. Given our focus on events that can influence execution risk or cost of funds, this kind of behavior is worth watching, even if it isn't headline news. What we're also watching, regional housing activity. In local news, the capital region of New York State ended 2025 on a strong note with fast sales and tight inventory despite elevated mortgage costs, according to market reports. Listings were up modestly year over year, and there were early signs of softening, such as first-time buyers turning to older or fixer-upper properties in search of affordability. Stories like this are important because they reflect cross-sectional variation in demand drivers, some markets tightening while others plateau. When agents and brokers hear about these patterns early, they can think ahead about strategy in similar local markets. Okay, that's it for now. I'll see you next episode. That's it for Mortgage Morning. If this was useful, follow the show and share it with someone in the biz. I'm Andy Baker. Thanks for listening.